Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And once again, it's just the two of us. No Eric Balchunas this week.
He's over in Europe. I don't know what he's doing there. Maybe advising on the snap election, perhaps?
If that's the case, we might not see him for a while. So let's get to the biggest stories right now. The more than $12 trillion global ETF industry. And we start with small cap underperformance, the group trailing the S&P 500's record run. We're going to dig into why the sector is missing out on the rally.
And in just a few moments, we'll speak with Greg Tuorto. He is portfolio manager at Goldman on why he is a small cap believer. Plus, the new weight loss revolution is led by drugs like Ozempic. We talked to Maurits, CEO of Tema ETFs, who built a fund around this trend. But first, as we mentioned, Eric is gone this week, so Katie is looking into all the flow action in the U.S. What do you see?
I'm going to do my best here. Let's take a look at where money is going in the week that was. If you take a look at some of the funds that are seeing love this week, up at the top, you have some of your index-based names, of course, the S&P 500 and the Qs. A little weirdness is going on with those S&P 500 funds we'll get to on the outflows. But if you take a look at the inflows, IVV taking in nearly $16 billion. The Qs as well taking in about $2.6 billion. You go down the list, global equities seeing some love, IWY and EFG also taking in inflows. So that's the good news. Let's take a look at the outflows as well. And as I mentioned, some weirdness going on. You can see SPY losing a lot of money, about $13.8 billion. VU as well, seeing a chunky outflow there. Then you go down, you can see dividends actually losing some money as well. So too was value. And RSP, this is an equal weight fund. When we've been talking about the divergence between big and small, and you can see equal weight losing about $900 million. But let's talk more about that divergence and compare small to big, and focusing on small. If you take a look at small cap outflows, it's been a real mixed bag. Of course, there's been a lot of people calling for a resurgence of small caps as we get closer to the start of the Fed's cutting cycle. And you've seen that back and forth going in the flows. February and March, huge for small cap funds. You can see taking in billions of dollars. Some of that came out in April, maybe as people got a little bit more comfortable with the idea that higher for longer will be here. Now you're starting to see people nibble again. May and June seeing in several billion dollars coming in. But of course, it feels like when it comes to the actual performance of small cap, Scarlett, we haven't quite seen that sector get off the ground.
We have been waiting, and perhaps we'll continue to wait. Joining our conversation now on small caps is Greg Tuorto. He is portfolio manager at Goldman Sachs. Greg, it is good to see you.
Thanks for having me.
So we talk about small caps and how they've kind of been waiting for their moment, and it hasn't really happened yet. Are they really being held hostage by the Fed's timing on an eventual rate cut?
Well, I think it's been a search for rate certainty since the fourth quarter of last year, when we thought we had a little bit of that, and you got a preview of what might happen with a really strong fourth quarter in small caps. Since then, there's been some fits and starts, some movement around the inflation data that has caused people to push out the rate cut bets till the end of the year, and I think that people want clarity about that, and I think that more so than in any other cycles that I've seen, it's, the small caps have been held hostage to that rate certainty.
And so when will small caps be a broad brushstrokes buy? Do we actually need to see the first rate cut for that to happen, for people to say, oh, look at these valuations, they're pretty depressed?
I don't think you need to actually see the first rate cut. I think if you look back to the fourth quarter, like I said, as when things start to get to the point where you'll have a little bit more of a percentage of likelihood of a cut, maybe in the end of the third quarter, the beginning of the fourth, I think you'll see that all clear being sounded. But there are a lot of positive fundamental signs for small caps, and you're asking a small cap guy if you like small caps. It's like asking a house painter if their house needs to be painted. But I can tell you that the valuation picture is probably the best in many, many, many years. I think the earnings picture is a lot better than large caps, especially in the sectors that we like. And if you look across small caps, the resiliency of the U.S. economy is really well set up there, and I think you can play that in a much better and more pure way than in the large cap space.
That fundamental story has been intact for a while, but it hasn't really materialized in terms of that outperformance. There is a debate on Reddit where some argued that the current market cap definition of a small cap with a ceiling of $2 billion should be adjusted for inflation. If you think about $2 billion in 1974 would be worth about $12 billion today, and that this outdated classification system no longer accurately represents the size and economic impact of companies today. What do you think about that?
I do think that there is a kind of a little bit of a prejudice against size in the small cap market. And I do think that part of the smallest of the small get classed as low quality, which I think people have, kind of used to kind of as another excuse to avoid small caps. We tend to think of small caps in the $2 to $7 billion range, 1 to 7 if you widen up a little bit. We tend to stay away from some of the lower cap ones, not because of quality, but because of liquidity. I think that on the ETF side of things, we want to make sure that there is enough liquidity for everyone who wants to participate. And I do think that there is some desire, and but from the benchmarking folks to make the average size of a small cap a little bit bigger. But it's one of those things that I think it's beauty is in the eye of the beholder, and I think that everyone has their own definition of where it should be.
So let's talk about one of your ETFs, of course. GSC is the ticker. That is the Goldman Sachs Small Cap Core Equity ETF. It's actively managed, has about $32 million when it comes to its portfolio. It's outperforming. You look just year to date, which is, I recognize, a pretty small time frame, but you're up 5%. The Russell 2000, for example, is down about 1% on a total return basis. I mean, where are you finding the opportunity when it comes to that portfolio?
Yeah, I think it's been in a couple of areas. Consumer and industrials have been the two areas that have led a lot of the gains for us. We've also done okay in tech, mainly in semiconductors. I think there's been some larger benchmark issues in the tech space. MicroStrategy, Supermicro being two of them that have been headwinds for us. But if you look in consumer, the retail and restaurant space have done quite well, and I think that that's been a big tailwind for us. On the industrial side, a bunch of different things. Industrials is a catch-all category, as I'm sure you guys know, but areas in aviation, even with some of the Boeing issues, areas in the water space and in the electric utility space. The equipment for electric utilities as we harden the grid have been really strong stocks for us as we looked over the past 6 months or so.
I'm glad you bring up Supermicro and MicroStrategy. They're small caps, but there's a lot of concentration risk there as well. They've done incredibly well, and on their own, they don't make up a huge percentage of the Russell 2000, even as they're the largest components. But I wonder, as they do well, don't they get too large to be considered small caps anymore, and so you lose out on the ones that do well? So
I've been doing this for almost 30 years, and I can tell you I've never seen small caps this big in a benchmark. And they usually don't make it that big, they don't last that long. Usually it's a company that's getting taken over and it doesn't really make it to the rebalance. So there's been a lot of oxygen used to talk about these two companies. I can tell you that on the bottoms up side of things, we can ignore them in the construction process, and we only really have to deal with them in the index. I do think that people who run a bit more of a, kind of a index plus or a more of a factor-based approach tend to have to deal with this on a greater detail than we do, just because we find enough ideas elsewhere that we don't have to worry about it as we build the portfolios.
Yeah, I want to talk about small cap indexes a little bit more because, of course, we always talk about the Russell 2000. That's the small cap index that everyone knows. Then you have things such as the CRSP small cap index, which I know VB, that's a Vanguard small cap fund, tracks. And then you take a look at what your portfolio has, just 99 holdings. When you think about the universe of small caps, that's pretty small. You compare that to the benchmark. I mean, how close do you want to be to some of the big benchmarks right now? Or is this the time to really go small in your small cap holdings?
Well, I think what we try to do is be benchmark aware, kind of understand where the sectors are and what are the reasons behind that. And I think once you kind of get that construction piece of it out of the way, then you start to look for your best ideas. And I don't think we don't think of ourselves as thematic investors, but if you look at where our big overweights are, consumer, as I mentioned, industrials, as I mentioned, parts of tech like semiconductors and semiconductor capital equipment, I think that's where you start to kind of look for conviction and the really best portions of the risk reward curve, and that's where we start to build some of our bigger positions. As you look towards the bottom of the portfolio, you look for things that are earlier in their conviction for us, pieces of the portfolio that might be a little bit less current in what they're looking for, companies in the biotech space, some of the healthcare names. And that's how we think about it. And I do think that allows us to be a lot more nimble when it comes to some of these benchmarks that are a bit more all over the place.
We go back to the beginning of our conversation about how they're being held hostage to rate uncertainty. And so much of the small cap story is built around a Fed rate cut. How do you do that without trying to actually time your entry? Because we know timing the market never works out.
I think that what we've seen is that if you try to time your entries in small caps, it really doesn't work for you. It works against you. Some of the best days that happen for the small cap space happen when they come out of the blue. And we've seen that, and when you've seen some of these big moves that are coming when people think you've gotten the all clear from the Fed. So we don't prescribe to the market timing in the small cap space. We do think that most people should have a small cap allocation. I think that amount has wavered over the last couple of years as small caps have underperformed. And I do think that some of that degree of rate certainty that people search for in small caps comes from the fact that some of that allocation has really gone into passive from active managers. And I think that passive piece of it has been more representative of what's being, kind of happening when the small caps are being held hostage to the rate cut dynamic.
All right, Greg, really enjoyed this conversation. Have to leave it there. Appreciate your time. That is Greg Tuorto of Goldman Sachs. Now, coming up, traders are pouring billions of dollars into an investing style that has so far struggled to gain traction. We'll discuss why we may be in a Quant-Factor era next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with ETF launches year to date. So far in 2024, we've already seen more than 250 ETFs launched. So far, that has us on track to surpass even what we saw in 2023. Of course, a record year. You had almost 500 new ETFs come to the market. And as you can see, that trend has been building for several years now. You also have closures picking up, which we don't have on the board. But of course, with this type of new momentum, this is an industry that is in growth mode. Let's also talk about XLK. This is one of the big tech sector ETFs out there. And it's had a strangely small weighting to NVIDIA. As you can see there, just 6% of the portfolio is dedicated to NVIDIA, which has been holding down its performance relative to some of the other tech funds. But perhaps at its next quarterly rebalance, those allocations will reshuffle. Let's also talk about our final topic here, and that is Quant-Factor ETFs. If you take a look at performance right now, they've actually been doing pretty well. You have your top 5 up there. Up in charge is Momentum with a nearly 17% year-to-date gain. Multi-factor not too far behind. And you add it all together, and actually billions of dollars have been flowing into these Quant-Factor funds.
So let's talk about this story with Bloomberg's Isabel Lee, who's been writing about it. What is driving this rally? I see momentum and I see size, and I think big tech.
Definitely. It's really performance, and this is a stark turnaround from last year. So of the 13 long-short styles that Bloomberg tracks last year, only two were in the green. And now this year to date, only 2 are in the red. So it's really a good performance, and it's because we have market conditions that have steadied. I mean, Wall Street has largely made peace with the fact that interest rates will stay elevated for a longer period of time, and it doesn't help that the stock market just keeps on rallying and rallying. And also on the flip side of that, yes, there is big tech, but a lot of people pile into smart beta because it doesn't have big tech, so they use it to diversify and hedge their portfolios.
And so we're talking about these massive inflows that we're seeing into the space. Who's driving that? Is that the institutional type players, the professional money managers? Are we talking about mom and pop, for example?
Some retail traders are driving it, and we've seen around 48 billion pile into this equity ETFs, and it's really a stark contrast from last year, and we're on pace to beat 2023. And we have BI's Athanasios Serafegis saying that of the 900 ETFs that are tracking smart beta, 600 do not have big tech. So this is really their bid to diversify. I mean, smart beta equals quant equals factor. It's a cheap way to get into those trades. As we know, these styles are usually reserved for hedge funds and they're pricier. So this is a cheap entry, which is why we all love ETFs.
I'm so glad you mentioned earlier about the current market conditions, how things are really calm, and you just have this market that relentlessly goes higher. What is the correlation between that and demand for these smart beta or quant ETFs? Meaning, if we get volatility, how's that going to shake out?
If we get volatility, then smart beta demand will be a little bit less. But I think it's also hard to compare because last year markets were good, but then we saw demand wane a little bit. So I think it's really the confusion around it. And now it's really more that, okay, maybe interest rates will stay higher for longer. Powell didn't say anything new. Maybe we'll see a rate cut later this year. So it's really more sentiment as well, and not just really whether market goes up or whether market goes down.
Okay, so making peace with higher for longer. Isabel, thank you so much. Bloomberg's Isabel Lee covering the markets for us here at Bloomberg. Still ahead, we dive into the weight loss revolution with Maurits. He is CEO of Tema ETFs next. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld. And Katie, you have today's drill down where we focus on one ETF. What is it?
One ETF. The ETF that we're talking about this week is HRTS. This is the Tema Obesity and Cardiometabolic ETF. It's all about investing in those companies that have been benefiting from the hype that we've seen around weight loss drugs. You take a look at this fund in particular. It's one of the first to launch with this theme. It launched in late November last year. It's an actively managed portfolio for about 75 basis points. And with that launch, of course, in late November, it already is close to $70 million in assets. So pretty strong start here for this portfolio. Let's take a look at what it actually holds. It's all about equities, 46 holdings in total. You take a look at what's at the top here. You have Vertex, Eli Lilly, no surprise, Amgen, and then Novo Nordisk. So again, global in nature here, just 46 holdings. Let's take a look at performance so far. Again, it hasn't been around for too long, but you compare it to both the iShares Global Healthcare ETF and the Spider S&P Biotech ETF. And I think it's interesting because it falls kind of in the middle on a total return basis. This portfolio has returned 23% since its inception. That is ahead of the global ETF, which has returned about 13%, but a little bit behind just XBI, which has returned about 25%. So strong performance, again, right in the middle there, even though it has some of those global names and already $70 million in assets, Scarlett.
All right. Here joining us now to talk more about this particular ETF is Maurits. He is CEO at Tema ETFs. And as Katie was showing us, HRTS has 46 companies, which kind of surprised me, given that when we talk about companies that benefit from the weight loss drugs, we're usually talking about Novo Nordisk and Eli Lilly. So I didn't realize that the universe could be expanded to 46 companies.
So when we think about the obesity opportunity, basically the GLP-1 weight loss space, there's obviously two big players already, which have approved drugs in the US. But based on our research, there's a whole tail of companies that are in early or advanced stage of getting products approved. And in reality, that we're focused primarily on the GLP-1 weight loss space, but we also address second-order cardiometabolic obesity diseases. The trifecta of diabetes, obesity, and heart disease are very closely interrelated. So when we think about what the opportunity is, it's GLP-1 focused, but also capturing what are the impacts between the three different disease groups I just mentioned. That's why when we think about it, this is not taking a Mag 7 approach to weight loss drugs doesn't work. Rather, there's a lot of risk in biotech investing. You need to manage that risk. You need to reduce that risk. By having a more diversified portfolio and also using expertise, biotech expertise to manage that risk is really important for us.
And so when you take a look at the weightings right now, you have Vertex up in front, followed by Eli Lilly, then Amgen and Novo Nordisk. Is this supposed to be equally weighted and have these drifted? Or how did you decide to have Vertex, for example, as the highest weighting versus maybe some of the actual drug makers themselves?
So we don't want to follow consensus. We really look for out of the consensus views. So for example, we were a very early shareholder in Viking. And actually we sold when it spiked, it's since dropped 50%. We think that actually Vertex has some very interesting innovation doing on the diabetes side that may translate over into obesity. When we think about a company like Amgen, Amgen actually has a very interesting therapy they're developing that reduces the frequency of dosage. So when we think about the next stage of GLP-1 drug innovation, you're actually looking beyond GLP-1 drugs today. You're looking at amylin drugs. And for example, Zealand Pharmaceuticals in Scandinavia is one of the early leaders in an amylin drug, which really has lower side effects. So less nausea, less muscle loss. So for us, there's two big players in the room already, but the reality is we think that this is not going to be a two-horse race over time. And really being an early investor in some of those second, third horses is really important. And that's why we're looking at companies like Amgen, Regeneron, Vertex, Viking, to name a few.
So I want to go back to the ticker of your ETF. It's HRTS.
Yeah.
And I know you talked about the second and third order effects of weight loss drugs and companies that may be involved. Why not play off of something that's more directly tied to weight loss? I mean, it could be like GLP-1, or what was another ETF that liquidated that's tied?
Oh, Slim.
Slim. Like Slim is available as well.
So if we were just marketing, we'd call it the GLP-1 ETF. But if you look at the innovation, it's actually looking already beyond GLP-1. So while GLP-1 is obviously the core ingredient behind a lot of the drugs we see today, we're trying to build a product that is not just trying to capture the interest of today, but actually is going to be here for the decade, or for decades, because we think this is ultimately a multi-decade opportunity. There's 1 billion obese people in the world. Novo Nordisk estimates that 2% of people are treated today. So when we're trying to build a product that is scientific based, is really based on expertise, and is not just trying to capture just GLP-1s. We capture GLP-1s, we capture weight loss drugs, but we also capture cardiometabolic diseases, which ultimately are at the heart of a lot of the obesity issues we see.
And I mean, going back to the way that you weight this portfolio and put it together, I hear what you're saying that you want to look beyond just the actual drug makers themselves, but that decision seems to be very, very active. That instead of just putting, the likes of Lilly and Novo Nordisk right at the top there, that you're actually looking beyond that and trying to pick out who will be the next winner instead of the currently established winner. I mean, is it harder to sell an ETF that is that active?
Yeah, so the reality is that in biotech, we believe you need active expertise. That active expertise is not to increase risk, but to manage risk. And that starts with having biotech expertise. So the person who manages ETF, he's a veteran 25-year biotech portfolio manager. The inventor of GLP-1 joined our scientific advisory board last month. And our view is that you need to manage risk. So when we think about Eli Lilly and Novo, they're the winners of today. But in drug discovery and in life sciences historically there's been a recurring trend of disruption with innovation. That's not to say that we're worried about what will happen with Novo and Eli, but we do think there's new approaches where Eli and Lilly may not be the first mover or the winner.
So the weight loss story is intact, and there's definitely a lot of fundamental tailwinds behind it. But there's a big issue here with supply and affordability. And we know that a lot of states and companies are limiting how much insurance companies will reimburse for those drugs. How does that factor into the portfolio manager's thinking about which companies he chooses?
So in our views, that's why you need to have a global approach. You can't have a domestic approach, which is why, for example, if you were to buy IBB or XLV, they don't own non-US companies. Some of the innovations coming in the US, some of the innovations coming outside of the US. Affordability will improve as prices come down, but for these companies, the TAM is so big that even if prices come down, we still think this can be a very big opportunity, both in terms of improving patient lives, but also in terms of the commercial opportunity for these companies. So our expectation is that prices could come down. They could come down quite materially to $6,000 a year, which is a material discount from what we see today. But even at that level, when we do look at the opportunity side, we see 1 billion people, 30% penetration, $6,000, that's $1 trillion market opportunity.
All right, sadly, we have to leave it there. Really enjoyed this conversation. Our thanks to Maurits of Tema ETFs. And if you just can't get enough of ETFs, you can subscribe to my weekly ETF IQ newsletter that covers the industry. But that does it for us. I'm Katie Greifeld along with Scarlett Fu, and this is Bloomberg.